Hey, greetings traders. Thank you so much for joining me. It is Tuesday and time for Macro to Micro Power Hour. I'm Samantha LeDuc, founder of LeDucTrading.com, and I am joined today by Jonathan Gibbons of VigTech.io. Here he is, coming in now. So I wanted to just share, if you will, that this is a regular feature on Tuesdays and Thursdays. Every other Thursday, it's Women in Finance and Trading, and today it is most definitely market structure, especially focus on volatility. Next Thursday, there will be a little housekeeping out of the way first. A follow-up to SPAC attack. So it'll be SPAC attack 2. Will this sentiment explosion in SPACs change as rates are rising and rapidly? So we'll address that next, the 25th, Thursday at 4 o'clock. Will be revisited by Craig, who was the investment manager who has traded these things since 2007, as well as George Kaufman of Shadden, who is the investment banker and behind the CHAQ SPAC, and has been very actively involved in structuring these special purpose asset corporations since 2003. So that'll be a very good follow up. Again, that is February 25th. It will be right after the close. In the meantime, we have this wonderful opportunity to talk with Jonathan of VigTech.io and myself about market structure. And I am very much wanting to get right into it because, Jonathan, I'm feeling, where are you there? New share, stop share. I'm feeling anxious on the heels of this kind of paper tantrum going on in bond land.
Yeah, I don't know. I think there's some conflicting things going on. So I'm curious to hear what your perspective is on it. You have to put some stuff together overall, because I still am sitting on this time frame from the VIX expiration tomorrow, options expiration this week, and then into the March options expiration as this window. That there's a bunch of different things that could transpire during that window, could go a couple different directions that are all market moving implications. So I think that I'm curious, your perspective on the different because you've been talking about the VIX structure, the front end of the curve, and then also the bond stuff that's been going on, today specifically, the curve. So why don't you kind of give us those thoughts? Because I'm going to talk about something different, I think, because like my perspective at the moment is there's a couple big things hanging out there that make me wonder if this kind of lingers a little bit longer than we think it might. So you first. You go first.
All right. Well, first and foremost, when we talk about on the weekend, what we're going to talk about on Tuesday, I presented this chart to you and said, I think we need to talk about this.
Yeah, for sure.
And give it a little color here, if you will, because you had kind of nailed it, which was there's complacency in the front end of the curve, and yet VVIX is popping up quite strongly, which is elevated volatility of VIX, indicating lots of puts are coming in actually for the unknown, whatever the unknown is. But first, let's start with this complicated chart, which I thought would be at least kind of the precursor, set the stage for our conversation about VIX. We'll go from there about on bonds. Explain this one.
So when you're looking at term structure, this is saying that basically the 6 month is at one of the most historical levels, and the spread between the furthest out and the shortest duration, like we track down to 9-day in the app and kind of give that away for everybody to look at, so you can see the whole term structure. And when there's such a discrepancy between the long term and the short term, there's something something wrong. You could add this to the pile of there's something wrong in the list that we have growing. But this is effectively giving you 91st percentile of historical values, right? Is pretty significant. And then while 30-day VIX itself is a 30-day measurement, so the term structure consists of very short term, which could be somewhere in the 9 to whatever is left on the expiration time frame for, so like this tomorrow, right, is February. Then you've got March, 30 days out. That 30 days out is always VIX. 60 days out, 93 days out, and there's a little bit of back and forth on different ideologies on using exactly 90 days for 3 months or 93 days, and weighting of that stuff and so forth. And then you go to 120, 150, and 180 days, and typically you're going to see a curve bottom left, top right of some structure. But it's not as steep as it is, sitting here right now. And that's what I mean. The short end of the curve is very, very, basically very beyond complacent. And you see that in broad market volatility as well, like absolute breadth, measure just broad market volatility. And it's completely complacent. And so, and it would make sense, right? Because to an extent, no one believes there's anything ever going to go wrong. Ever again, because everything could have possibly gone wrong, it's gone wrong and didn't matter. So people are trading accordingly, but then you've got the back end of the curve at a different perspective. So these things, something's got to give, and then one thing I would note while I'm just explaining the kind of the term structure is that it'll flip on the front side. So if you see the front end of the curve go up and the back end of the curve invert, so basically they swap places. That's typically when you're going to see some volatility start to pick up. And then also your vehicles that everybody wants to utilize, VXX, UVXY, SVXY, these vehicles all have a percentage weighting of the term structure in the futures. And so you can see them like maybe be bifurcated from VIX itself, right? Or VVIX. So like VVIX is rising and UVXY is like negative or flat. And that's a composition of that ETN, not necessarily being exactly those different vehicles. So, if that was useless for you, you can ignore it, but hopefully that helped explain to some folks, like, what are we talking about with term structure? I mean, really, at the end of the day, that means, measuring in really close proximity, and how does the put call stuff stack in that kind of environment, going out 30 days, 60, all the way to 180. And that curvature, right? That nature of that structure is really important to kind of utilize, and you can utilize in a lot of different ways. And so the 6 month VIX, sitting in the 91st percentile of historical values is pretty poignant. And then, while VIX is in the 62nd percentile. And if you go to the app, like our app, and you look at like historical, and you go to the volatility metrics, it's like a free part of the app, and you go to the bottom, or it's actually the middle section of the vol, you can see the historical, like, over the last 10 years, where is this usually ranging? And you could see that like last year was pretty abnormal, obviously, right? But like, this last 6 months to 9 months was even less volatility than the last, even that 10-year period of, 2010 to 2020. It was significantly, there was literally no volatility, right? And so this is now we're starting to see these structures change. And Samantha and I, if you just joined us, we've talked about this for the last probably about 60 days on and off, is that these legs of the stool that were kind of driving this market have started to fall off. And so one of the things that fell off was share buybacks. Then another one that fell off was tax cuts. Trump's tax, it's like a lot of things to say real quickly. Trump's tax cuts, being reversed, different things, the blue wave kind of changing the way that's going to go. Another way, right? So you've got the kind of the Robin Hood crowd that's kind of fizzled into options environment. It's not necessarily spiking; it's more flattening out. So that leg that's driving this thing has started to flatten out. So now we're left with bonds and vol and dollars, right? And so what's going?
Did you say Dodge?
No, I didn't say Doji coins. I said dollars. I said dollars.
Dollars. Okay.
Dollars.
Sorry.
But we still have Doji coin, right? And you've got that chart with Elon, because it's that's where I was going. Like there's something to be said that
we'll get
I'll
there.
touch on that in a minute.
But you just said bonds, yes, and dollars. I think that's what's happening right now, is the next leg of the stool, if you will. I don't know how many legs there are, but what I wanted to say was, or highlight, say that sentence again. The short end of the curve is more than complacent, right?
Yeah, beyond complacent. Yes.
Beyond complacent. And then I came across, Bloomberg guy here, JP Morgan Chase gauge of investors' cross-asset complacency based on valuations, positioning, price momentum is nearing the highest level since the dot-com bubble burst 2 decades ago. And it's kind of funny how they are, really in sync in some regards. So that was just one when we were talking about that VIX curve, if you will, and then this complacency that is proven also in asset allocation. We have just got to talk about VIX because I'm getting into some levels in my stock bond volatility ratio that are starting to look like they're just about ready to tag. So that has been pretty helpful in the past as a tell for a regime change. In other words, this aura of volatility that we keep talking about coming into the market isn't going to be one and done. It was a few weeks ago, and that was a different type of tell. And I want to find that one because that was pure technical analysis. In other words, when we talked about that, it was January 20th, and I had warned that we were going to get a huge impulse of volatility. That was, let me just find that real quick, based on really a technical read. It had nothing to do with my stock bond volatility ratio. And I just want to show you that chart real quick as a reminder because it's really good, but I have to find it. So hold on.
While you're pulling it up, what I would say too, is that one thing that we've seen, usually you're not like, a lot of folks do technical analysis or charting, different things that they use. And a lot of people say don't chart the volatility instruments, the ETNs and so forth. We have seen, take away the charting piece, as far as volume flows and money flows coming into those products has been steady for about 2 months now.
So that's because of that one-day wonder. So this was simply a technical read on January 20th. I said to clients, it's just, we're going to have a big impulse here of VIX, and it wouldn't surprise, right? We're right into the apex. And sure enough, we had a 62% move in one day. And then they're like glomming on to puts, which is why VVIX has stayed elevated. But now talk about why it has come down so distinctly, which has been also the case, right? Where it is sold, maybe not to the extreme of, the short sellers since Volmageddon, but in short, it has been sold and now it's starting to fill that gap, the February gap I'm talking about, before we had the COVID risk off event. It's starting to fill that gap, about $18.50. That would be awesome. Honestly, I would love to see it fill that gap because then it's filled and it can round head higher. So the reason why I bring this up is not that chart is not technically poised for volatility, but typically that's a precursor to a regime change. Volatility is coming into the market. There'll be an aura of volatility that just kind of comes in, whoosh, threatens your, resolve, the bulls anyway, goes back in. Oh, everything's fine. Buy the dip. But this to me is now forming, and again, this is a different metric that I use, a tag of my stock bond volatility ratio, which is going to tag this week. So that tells me we're going to have some volatility in the next week or two, even though everything still looks so rosy. And then today coming into the markets, and we have a bond route, for lack of a better word, that looks very akin to like a taper tantrum. They're getting a little nervous here on the bond front. And one of the things I wanted to bring up was, yes, hold on, how significant this is actually from a sell-off standpoint. And tips, LQD, TLT, they are really elevated. Let me just bring this up here. Share a little screen here. Okay. And as folks know, I have been bearish bonds and gold complex, if you will, precious metals for a while. And so this particular move down has not really surprised me, but today did. And I'm not easily shocked. I raised 3 teenagers. So seriously, I can look at levels and I can say, yeah, I can see this is really a drop. So did LQD, fall from its little safety zone well below the 200-day. Forget about, the tips. That was a solid break lower. And with it, gold is absolutely not opening up strongly on a Tuesday. That's actually opening up very weakly. So that whole complex to me is still at risk of further weakness. But the TLT in particular has some levels on the weekly. Let me show you if I can bring this up here. I had posted this, to be watched, right? Which is, this is a TLT on a weekly. This is a stochastic indicator for those who still, we can do the macro, we can do the market structure and the intermarket, but this is just pure technical read. I've never seen this stochastics level hit a 0.26. That's very low. Like on a weekly, I've never seen it hit that low. So there's something in the structure here of this bond sell-off that should scare the Fed. I just think this is, and then I look at the amount of puts that are coming in. Did I actually share that screen? No, let me do that. This is very much a situation, sorry, I thought I had that shared, where the oscillator is extremely oversold. When that happens, there's also more, let's say, weight of evidence that we might have a very sharp TLT bounce from this level, and then it can continue down. But my point is, there might be some more volatility that comes in even sooner than what I was projecting, which was the next week or two. So this TLT very well could be this outlier, if you will, that reverts, which would be kind of surprising because right now, we've talked about this, there isn't a lot of selling under the surface. Even my indicators on a swing, an intraday time frame are showing buying. So intraday and overnight is still showing accumulation. But this bond move looks a little bit different. And so then I wanted to kind of talk about the background of what's going on. And also, if you notice the option flow, the HYG puts that are coming in, really large. I mean, and I know that's a surrogate for the SPY, but it's like with a 20 IV, for April. And it's literally, the put spread came in earlier. It grew over the day. The 83 by 86 put spread for HYG in April. That's like spend 30 cents to make $3 kind of trade. And the TBT calls continue to come in. They're just hammering the TBT calls. So the whole bond auction, action to me was a little bit stronger. Like I understand there's a fade, there's a stronger push, and then there's at some point a collapse. But this, to me, I think was in reaction to what was printed in Bloomberg this morning by Yellen needing to move reserves back to the Fed. And how will the market handle that? And what will the Fed do in that regard? So I want to show you that article as well. But can you shed any light on your market structure that you've seen in bonds while I grab those articles?
Well, I mean, TLT has been like TLT has been a problem for a little bit. And then you've got HYG and that whole senior loan space. Do you have BKLN?
Yeah,
in there?
That one too.
Yeah, is it the same? I haven't seen it today.
Nope, not like TIPS or LQD, not anywhere.
Okay, all right. So like the senior loans are always a major concern. The high yield grade environment is obviously, that was the thing that they came out and bought outright and monetized through BlackRock back in April and have never stopped since. So to see this to have a problem, there's either two things in my mind. Like we are so extended in every way, shape, or form in this market that it can, and the bonds are significantly bifurcating from the actual price action itself. And there's a bunch of charts out there. I'm not gonna pop one up that would show that. But effectively, is it more like the taper tantrum in 18, at the end of 18, right, where it was October, November, December, or is it the precursor to something different in the March timeframe? I have a problem with the being more than a kind of a flash in the pan, because you have the March expiration with a bunch of incentives that play with that, and the market can continue to kind of float, because we're seeing that total different market structure perspective from the equities and then the bonds. So are bonds going to like level off here, or is this something that is an overreaction potentially today, where people are repositioning based on the overreaction? I kind of always use the senior junk as a leading indicator of like a significant concern. That's just my color on it, rather than necessarily HYG itself and LQD. But that's like those two being, to me at this point, like the Fed outright purchasing them. They have I'll look at my price here in a second on the chart, but there's a level on HYG. It's like if it's above a certain level, it just doesn't really, even like coming back a little bit, it doesn't necessarily matter too much from a price structure perspective, from a market structure perspective. But the thing that would probably be the kind of determining factor here is this going to necessarily be something that happens instantaneously, or is this something that leads to kind of more weakness, maybe starting in April? And this will prove to have been basically a what do you call it, a flare, right? That there was going to be a significant problem here shortly. So you could be some repositioning based around that, where people are getting ready for a more significant problem. I can see that totally, right? Like I can see
yields
that
are
totally.
getting away from the Fed. So I mean, this is really going to be tough for them to control the long end, and it's going higher, and the rate of change is extremely strong. So that's one thing that I do in my intermarket, and I've shared with clients that this rate of change in the yield pop that has been, going on here for a few months is picking up speed. I mean, where it opened today was above monthly support. So just from a yield curve steepening and the yield pop strength, it is still in play. But one thing I wanted to mention was, do I have this shared? Yes. Yellen this morning, shift on vast treasury cash pile poses problem for Powell, and move pushes down money market rates, may make them go to negative. It was interesting in this article, which is why, I was looking at this. I tweeted about this actually this morning, and then bonds just really continued to press lower. And it was impressive because they're immediately reacting. Zoltan of Credit Suisse fame, for those who know this analyst, says Treasury transfer will unleash a tsunami of reserves into the financial system and onto the Fed's balance sheet. So this is from this article where he's quoted. So the translation, at least, of market plays, how will the bond market react to this tsunami of reserves being transferred back over onto the Fed's balance sheet? Well, one way is the money market will likely go to negative. Okay, so they talk about this in the article, and I had tweeted about that because, where is it? It's on here somewhere. Because to me that looked like so 1999. So what do I mean by that? This Fed funds rate right now, and talked about this with Jared Dillian last week on Thursday. Yes. And I mentioned, Fed funds rate has like a 5% chance of rising this year. And he said, nah, it's zero. It's not a thing. I said, what about the discount rate? So the discount rate in regards to this money market rate going to zero, one way that they could counteract that is to raise the Fed discount rate. So when did that last happen? In regards to, I shouldn't say, before I get to when did that last happen, raising the Fed discount rate is one way for that overnight lending that will kind of force folks more for banks into dollars, which would also give us kind of that bullish thesis or tailwind, I should say, for dollars rising. But what's happening right now to me is just a warning shot. It doesn't mean anything right now, but the last time we got into one of these very exuberant market backdrops, right, which was 1999, tech bubble 1.0.
Yeah.
This still continued from the November FOMC right up until April. It was March, actually, it was the last Fed discount rate increase from November to March, where the market still continued higher a goodly amount, and then it didn't. So that's the closest parallel or analog that I could find when I was looking at, the examples of, okay, I just read that this morning before I opened my trading room. Okay, I can see where this is, potentially problematic in regards to how they're going to deal with this liquidity, hose. Money markets going negative, they're not going to want that. How are they going to prevent that from happening? So anyway, I'd love to hear some bond traders with, real experience in trading this environment. I'm looking for a narrative basically that is, trying to connect some, basically some macro narrative with my intermarket stuff, which says my stock bond volatility ratio is about to trigger, and it can be very explosive when it does, and not just for a trade, but like February, March kind of thing.
Yeah.
And it stays triggered, and it stays triggered, and it stays triggered, not just for one day wonder. So I can't help but, still look at this, particular chart and go, okay, maybe history doesn't repeat, but it sure as heck looks like it's rhyming.
Well, that chart, that's actually, I was hoping you would have that one, because you could see what's the market drop from the top in, what is it, November, right? Like it's the other one. You got to share the other one. We see the Tesla chart right now.
What?
Yep. There you go. Okay. So the 4,800 to 2,900, is that right? Is that about the first move?
Yeah, 48.16.
First initial move was what, 50% drop, right?
Something you're talking about from here to here. Absolutely.
Nah, the drop, the first drop.
But it is worth noting that this is about 2,500 and it runs to 4,800.
No, 100%. So like we're, and that's where I was going with it. Is it like a flare, or is it like, this is happening, instant, this can happen any moment now. So I'm like, when I sit there and look at like kind of all the moving parts of the market at the moment, right? With the options expiration this week, then you got the major implications of the one in March, and then the implications across crypto as it relates to Tesla, as it relates to Bitcoin, as it relates to ARK, right? Those kind of too big to drag the market around funds and those ETFs plus the Tesla plus the Bitcoin, they're all kind of a macro kind of simultaneous trade together at the moment, and they benefit significantly at that March expiration for different reasons. And so does this happen here? And then we continue to see, a volatility kind of, boiling to an extent? Would this continue to get worse, or do you think that it breaks, this type of bond bifurcation breaks before any of that and it doesn't even matter? That's kind of the big question I have between here the next 30 days, because I do think that analog from the NASDAQ in 1999 is in play. I definitely think it's in play, because we're left with like totally just a mania environment at the moment, where it's just by the greater price. That's all that's happening at this point, and the equities being driven up mechanically by options trading. And so, we're way past anything structural that would hold this thing together once that does trigger. So you're 100% right. And to go all the way back to that it could be very, very like, not just one drop, but like simultaneous drops and get into a doom loop. But like, I go back to what I was saying a minute ago about like kind of charting volatility, just to clarify what I was saying, because I think it matters here, is that because it's part of this whole narrative, is that not necessarily like the folks that like want to like actually count or stuff like that, like the VIX complex kind of gets a little complicated. Gap fills, market structure, et cetera, perfect. They work every single time. What we've seen and have vetted out with a couple other different kind of information sources and so forth is are we really seeing such a kind of an inflow of capital into these proxy ETNs that we're seeing in the last 60 days? And no matter when it spikes or when it drops, it's money flow and velocity flow has been into these things. So what is that? What for? Why? And I wonder, right? It's starting, and that goes into the first conversation we had. What are people beginning to think risk is looking like in the medium term overall? And I think that that's to be taken into account here, especially with the bond narrative that's sitting there. Is that vol is like, set the technical pieces aside, even like me from a market structure side, just flows in, right? And people are sitting there and starting to get to look at that. Now you're seeing bond flows in, puts, right? These types of things on HYG come into play. You're starting to see the actual action coming to the table is looking like, a little bit more, it's getting a little heavier by the day, but yet at the same time, we still have this March expiration sitting out there. So it's almost like a, do you think it's a short spike and then you get back one more high again? I don't know, but I definitely think.
And the Tesla covert also come due. So we'll talk about that. But I think there's real reason why these yields are, moving higher. This is kind of a thesis that we've also talked about and I've written about for months, which is, this theme of things over paper, right? So
yeah, totally.
Once we got the reflation trade really moving last summer, and then the Biden bid, and then the Pfizer announcement, then the Georgia blue wave, right? And then, constant stimulus. But the point is this whole value, okay, and now the Texas deep freeze, or I should say 14 states with, electrical blackouts rolling and the grid going down, boosting oil and again, related plays, it really is actually historical for things to go higher over paper when you're talking, long-term correlation between inflation, the expectations, and various, financial real assets. So I grabbed this chart from Sober Look, real assets, commodities, platinum became really strong buys. And I have to show this because I love this. Meaning, this is since the 1950s. These are the asset classes that have done really well in periods of inflation. So the inflation expectations and, there's this debate constantly, inflation, stagflation, the point is, this has been the rule book. We see yields moving higher. We see commodities over stocks. It's my theme anyway for 2021, but we definitely see commodities, platinum, oil, etc., real estate, hot fire flames in all kinds of places. Gold has not caught a bid by any stretch. But the point is, this is, also helping to support this move, I would think, in the value rotation, which may just be starting, honestly. And then the other thing is when it comes to earnings, very much what is real and what's perception. I grabbed this chart by Charlie Bilello, sorry, and showing that S&P has reported for Gap anyway, for SPX, the EPS growth is a negative 19%. Nobody seems to care. We've talked about this before. They're pulling forward, right? All the expectation. So, but the reality, and I have then taken this and said, okay, this is a great chart. 82% of companies reported the S&P Gap earnings are down 19% year over year. This is my, intermarket thing that I do, which is basically moving average and then trying to time for trend trading on a monthly time frame when it's really safe, in other words, to stay long, or when there's an inflection point to go short. And this has been a fabulous way to tell market big picture, long and short, for trend trading timeframes. And you can see here, we're way the heck down. This is current, by the way, you can't see it, but it's the 12th of February. And SPX is way the heck up here. So what do you think owes to this huge divergence? This is Gap, and this is SPX. What do you think owes to that divergence? Four letters. You ready? Tesla. This is inflation, this is EPS growth expectations that have been pulled forward. Check this out. 2000 highs, right? How much of that is Tesla? All of it.
Not surprised.
Isn't that just like, wow? So our market right now is being held up by this pull forward EPS growth in Tesla.
There is this is fascinating to see, right? Because I'm.
And remember, consumer discretionary is 17.5% Tesla. So it's the same difference, right? So I put these side by side. Like I got these charts and I put them side by side, and I should have, anyway, that's impressive. That's scary. It just basically means that we're really kind of dependent on Tesla, and maybe the folks know that might not be the best bet.
Well, yeah, that and he's buying he's buying Dogecoin and Bitcoin and
it's hysterical.
He's tweeting about it every day at between 7 and 9 a.m. There is a guaranteed tweet from him, RE Crypto. I'm not making that up. You can go back and check it out. It's not almost like every day. We can't count the weekend, but you nailed
it. I literally tweeted this earlier, going, okay, so Tesla, now we have to have eyes on Tesla since this matters so much, right?
Yeah.
We're going to talk about the bonds again and volatility again, but this really matters so much now. This is from Brent at Spot Gamma, and we've talked about this in the past. It's a great chart. Yeah, he posted back in, I'm sure it was December, but do I have a timestamp on here? We can assume it was, December 10th, there it is. Okay. So large amount of in the money call options expire, and then Elon's, coverts mature. This is really where I think we'll get a little bit more of that selling that can possibly come in. In the meantime, what does Tesla stock look like? Just one big sideways. Just literally from the first of the year, it has just gone sideways. This is week 8. Very impressive, but not really, right? So there's just nothing going on with Tesla as it relates to price. And you're hysterical that you just said that little bit about he's buying Dogecoin, because literally back on this, when he sent this chart out, and I grabbed it and I've been holding on to it, and of course tracking sales against it, like Valley Gifford is down to 5% share of Tesla from 12%. And I'm sure that they sold because they had big gains, but I wonder if any of that was because they put, Bitcoin on their balance sheet, right? So, but the point is, he had an absolutely hysterical, he said they're selling calls. Brent said of Spot Gamma, they're selling calls to buy Dogecoin. I think he said that as a joke. I think it's actually true.
Yeah. I mean, I've heard, and then he's got a short on Virgin Galactic, so SPCE. So he's taken out a short position against his competitor. It's also word on the street. So I think my 2 cents on this is that I mentioned this last week in conjunction with this. Also seen some discussions just internally, amongst ourselves, our team, and people can take this for what it's worth, because there's no deep research presentation behind it. So just take it for what it's worth. So you've got him talking to Saylor from MSTR, right, from MicroStrategy in December. And, real corporations should put Bitcoin on their balance sheet, right? And he says, well, how would I get such a large purchase? And then they said, take it offline, call me. So he takes it offline, and then it proves out that he bought Bitcoin in December. And then you time that out with his, he would have made on the gains, they're going to be profitable this quarter based on just the Bitcoin trade alone that was placed in December and where it sits now. So his earnings are now made based on that. And then he's pumping every morning since December, right? Starting January on, he's pumped Bitcoin. And there's been a few people say this. I simply don't understand how this isn't securities fraud, but neither here nor there. So you look at that in correlation to the date of those expirations, and you look at BTC and the tether prints and the moves in BTC, and you look at him and the pump with Doge, and you look at Tesla being now a proxy for BTC and BCC being a proxy with Tesla. They're kind of moving in conjunction, and all this narrative he's then pandering to the option buying crowd, right, with all of his targeted memes and the meme stonks and all that stuff. And there's tons of research that Lily's done on all that. And so, when you kind of compile these together, when you look at MicroStrategy, you look at that, and you look at ARK, they all kind of benefit. And then there's been some unloading of the shares in the last, couple weeks. So, I'm not, it's just, it is what it is, right? Like, it is either nothing or it's everything. And the big thing is kind of sitting in the middle of this is the Southern District of New York's Attorney General's ruling about Tether, which is supposed to come out any day, I guess, on whether that's going to be a shutdown and seize situation or that's going to fly. So this could go the other way, where nothing transpires. This kind of culminates to innocuous state, and we all just kind of go about our business. Or there could be more to this. Now, the timing of all this seems to be very interesting, because we're really, kind of moving on the meme stocks back and forth at this point. And that's one of the last final legs of this whole thing. Plus now you've got the bond analog, plus you got the volatility flows. And so we're sitting here, it's like almost like, it's under the surface. This thing's still sitting out there, and it's one of the primary conversations. So I just, I don't want to judge anything like on the long-term efficacy of Bitcoin or anything like that. So nobody get like kind of going down the wrong path with what I'm saying here. I'm just talking about this particular case where they are all intercorrelated at the moment, and it's highly interesting as it relates to his payouts and that March expiration. And that is not him, buying shares of the company, like, being paid. That's him being paid, right? Like cash, right? And that incentive alignment across all things, as it relates to politics, as it relates to businesses, as it relates to anything, incentive alignment is one of the biggest things to look at in anything, as it relates to a trade, as it relates to where you think things are going. Charlie Munger said, show me the incentives and the incentive structure, and I'll show you where the business is going.
Well, and Kathy Wood might have something to say about this, but we won't know until the next installment. But it's kind of interesting because I had listened to, because I wanted to see where she was going here with her market call in regards to Tesla being, very sideways for the past few months, literally, I should say 2 months. But Kathy Wood here has an investment interview with Yahoo Finance, and it was just recently, in fact, a few weeks ago. And she said, we're not an equity bubble, but a bond bubble. And she's proving that out by basically referencing fixed income flows, et cetera, et cetera. But in this interview, which I thought was really interesting, she's saying value investing is not safe. We have disruptive innovation for the next 5 to 10 years, millennial fueled short squeezes, help bail bond buyers out. All of that stuff was very interesting. But one thing that she did say in that I didn't highlight was she didn't agree with MSTR, MicroStrategy, putting Bitcoin on their balance sheet. And that came in right before Musk announced that they had bought Bitcoin to the tune of what, 1.5 billion?
1.5 billion, yeah.
Yeah, so I'm just curious, as a sentiment read, does that mean she will sell? I haven't heard anything since. I just posted that last week, so haven't followed up.
She's in a tough spot. She's so huge now, and everything they disclose, everything they've gotten in the habitual nature of disclosing all trades. So she's like kind of trapped.
Yeah, she definitely is trapped.
And trapped by her own success. To offload and a lot of folks have talked about this in a lot more depth than I can go into right here, but basically once you get that big and you're practicing that way, you set yourself at risk if there's any type of change in flow stream on you, or change in the stream of the market on your strategy. You're very, very stuck, and your liquidation can become very rapid. So I think I'd be very curious to see what she does with that. She's in a lot of different stuff. I think she's done a great job. Like a lot of the things that they invest in are all they had historically done a lot of research. I haven't followed them much lately, but it's all in kind of pioneering stuff. So the whole strategy makes sense. I agree with their strategy theoretically in a perfect world, but I don't think we're entering a perfect world at this point. Like there's some significant implications to that kind of strategy is when you have a potential move in monetary policy that's forced. And that's, I think, what you're alluding to with bonds and everything else is that, and it really is a genuine thesis that you do all this and you think that there's no ramifications and you can continue to do whatever you want to do into perpetuity as it relates to interest rates and as it relates to yield curves and everything else. But realistically, market sets it or you set it. So I think that the the unintended consequences are where we're kind of starting to tread, right? We're treading into unintended consequences with inflation. Inflation is definitely rising its head. If you don't believe that, I don't know what to tell you. I mean, real estate, oil, all the hard stuff is really starting to pick up hot.
This is a fun theme if you're, things over paper. But it is also at threat of any time the Fed coming in and, whack-a-mole getting those rates down. But they haven't.
Well, I mean,
they're think about what's rise.
Think about they're in a rock and a hard place. Go back to Chris Cole's comment, right? You've got the pensions, right? And you've got the corporate debt. And both of them are on different sides of that situation. I mean, there's a lot of
Oh,
there's a lot of, what do you call it, like people at the table with different objectives now. With a Fed that's severely trapped, you got like a Kathy Wood that has a different objective, than the pensions have a different objective than the corporate debt. I mean, these are all different objectives that all are directly correlated to interest rates, directly correlated to the yield curve, bonds in general, at the same table, different seat. This gets now who, can you sacrifice anybody? Now what was like, I can pull on different levers, right? And there had always historically, back to 2020, early prior to 2020, and Ben Malcolm was the one that really kind of woke me up to this, was, every time you have the fiscal lever pulled, right, or pushed, I should say, the monetary lever was pulled. And every time you had the monetary lever pushed, then the fiscal lever was pulled. And they kind of offset those historically. It was never the both at the same time. And you can see the both at the same time last April, and since then, and since our moves, right, and the equities and everything, you've said this 15 times, everything's up 80 to 100%. And so, we've got both of those pushed forward. So now are we entering kind of like we've crossed over a chasm. We're on the other side of this. That's like a jungle. We're not really sure of any of the kind of consequences of anything that's been done, because it was all done, as King Griffin said in that interview that I shared, it was done so quickly and without real-time data sets, in haste. And once those things are put into motion, you can't pull them back, and they create all kinds of unintended consequences. And I think that is a correct statement, and that could be potentially what we're looking at here. Why they're not necessarily going to be exactly like this time period before, or that time period before, because you've got a bunch of different stakeholders at the table.
But they work a lot faster. Right. Muscle memory is just, and the gamification of the retail traders, which we do have 100%. To address, by the way, because one of the reasons why we wanted to talk about volatility was this misnomer here that retail can actually move the VIX. And you and I both.
No chance.
Yeah, exactly. They're not buying futures, VIX 2 months out. They're not playing. They don't know how to play. It's not really an issue. These other bond, crash issue, the silver hoarding may be an issue. The volatile. Now I want to talk about the silver, because I read a really interesting article that stimulated an aha moment. And that's kind of how I work, right? I'm like looking for data points to connect. And, one of them recently was, look what's happening to the 10-year swaps. They're crashing. Bonds then start to really fall faster. And they have been slowly falling, but they're picking up speed, and with LQD and tips and such. And it's not reversion of the reflation trade. Inflation, the yields are still strong with all the expectations, not just oil, which is helping it all, but palladium, platinum, uranium, oh my gosh, you strip out oil and you still have a whole bunch of underlying commodities that are just way higher. Farmers are having a tough time because the ags and the grains, copper is more expensive, et cetera, et cetera. But the interesting thing to me was that silver, I wanted to comment on that article actually, because I thought it was I don't want to call it old timers, but it was one of those articles where I thought, I didn't think about that. But did I interrupt a question you were going to ask, by the way?
No, go ahead.
Okay,
no, go ahead.
It was basically agree or disagree. This article on silver that I can reference was basically talking about how it serves as base. Well, first of all, we see silver physical extremely elevated in pricing. So the premium is very, very high. Inventory is very, very low. And that's basically all there is to say about that. Supply and demand of the silver physical is definitely whacked compared to the paper market. Paper market is very subdued. It hasn't really fallen apart. Gold looks much weaker. Miners, GDX look much weaker. We've talked about this for a while. Totally. Silver's kind of correcting in time, not price. Right. And I think it's getting, supported in some regard because the silver physical is so strong. But the article basically goes, talks a little bit about the difference between the physical and paper silver. Potential trigger for higher US dollar. That was, and rates with it. And here's why. I'm quoting a little bit. Silver run is similar to a bank run. Bank runs tend to feed on themselves. Monetary demand for silver is essentially a run on the dollar. which is itself primarily a monetary reserve. The way you stop a run on the dollar is you raise interest rates on the dollar. But what if doing that is impossible because the level of debt in the economy is so enormous that raising interest rates would collapse the economy and the stock market? So if you can't raise interest rates, the only way to stop a dollar run and flight into precious metals as a monetary reserve is to push the paper price of silver down by shorting silver futures. We see that. Banks have a vested interest in doing this because if the dollar falls too fast, the value of the bonds on their balance sheet plummet, causing a systemic banking crisis. If silver stops rising in dollar terms, though on the paper markets, the demand for it as a monetary reserve tends to eventually ebb, kind of stabilizing the dollar that way. So pushing the price of silver down by shorting futures has other consequences, which is what's happening right now, right? The physical is really hot, but they're shorting, keeping that silver paper really, really low, and that it prolongs physical shortages, forcing backwardation in the silver market. And this is where we're at right now. So
I agree with that. Yeah.
Yeah, so that was kind of a nice summation of what the heck is happening with silver, physical versus paper. And the point was more in the article, this is where we come into a support, if you will, or tailwind for higher dollar and rates.
Yeah, there's a lot of kind of cross correlated components to that kind of summary right there, right? Like you're talking about the bonds, you're talking about the dollar, you're talking about the shorts on the silver, you're talking about the physical market. EV being pretty popular this last year definitely has had some implications on the tangible side, right? Because silver is used as opposed to gold. Gold's primarily precious in nature, and silver is actually an industrial use, especially in the EV space. So I do think that can play into it. I didn't hear that kind of touched on as a little bit in that, but I think I would add that to that statement. I think the like physical stuff. I would have put it, like the silver thing is like it's an older conversation because it goes all the way back to Lehman, and then it goes into JP inherited layman's position and so forth. And there's kind of a ton of research as it relates to that particular position, and then the shorts in the market. That's kind of like the SPX conversation about short. I'm gonna blow the VIX out, kind of buying calls and so forth like that. That's one of the largest markets, if not the largest market in the world, and silver is massive in the futures market as well. So I don't know that people can move these things around at all like that. Like the thing that I would say, I'm trying to make some sense of what I'm thinking because a lot of different thoughts running around in my head at the moment when you start talking about silver that relates to money, is the dollar is kind of sitting there in the middle of that ring of the four stakeholders, and then rising interest rates. And then silver's kind of sitting at that table too, and so is gold, and so is Bitcoin. And everybody's waiting to see what the move is of those interest rates that's forced. And I would think of the room kind of shrinking in on the Fed in the sense that the move, I can kind of move around that room a little bit more freely. As time has gone over the years, the room just keeps shrinking. And when they raise rates or make a move, then there's like a cross impact. And that's kind of what the summation of that article kind of or the little phrase right there is breaking down the paragraph, is that and now we're into the unintended consequences. If I have to do this, and that's the lesser evil, then the impact on that on the other side, I just let that be and let it ride. Well, theoretically, they've been able to keep kind of all that, like what do they call it in farming, like corralled, right? Like all those things have been corralled, but I don't think that you're going to be able to see things be corralled anymore in the way that they were. And this could be directly impactful to silver. It could be directly impactful to Bitcoin. It could be directly impactful to bonds. It could be directly impactful to pensions. They got to pick, because somebody's not going to make it out of this room alive, so to speak. And that's what I would say is we're kind of at the point where the table is everybody's sitting at the table. Somebody's gonna get licked pretty good, because I mentioned this last week. One of my good friends last 15 years is in Valdosta, Georgia. They run a huge lumber organization, huge organization in that part of the Southeast. And they're months out, like delays on major construction projects for framing and lumber. And like these things, like, this is like serious. This isn't like short term. These are now starting.
We talked about this. I actually did an institutional report last summer about wood, lumber, and supply inelasticity, and suggested, the long, the short, the long again, because this is a really big problem. What happened in British Columbia, kind of the perfect storm with a beetle infestation, et cetera, et cetera. But the point is, you're right. It's a wider area. The lumber, the commodity, if you will, palladium, that doesn't have anywhere near as supply inelastic resources as lumber, and the mills, that are going to get the bid for sure, because the few that can are just.
And that table is shrinking, and the interest rates. I think that kind of sums up the whole conversation. Is like VIX is sitting here, and Vol is sitting here, staring right at the hand, right? Show me what you're going to do. Bonds are staring right at it.
Commodities are showing up. Inflation is moving.
Commodities are there, and equities are drunk as a skunk, right? And they're totally obliterated. They're the obnoxious one at the table. And then you've got Bitcoin, and then you've got some of this other stuff. Everybody's sitting there, pensions, corporate debt.
So let's talk about Bitcoin a little bit, because this is a question actually. Martin asks, regarding inflation, what is your call on gold generally, and is Bitcoin acting as a proxy in everyone ignoring gold, because that's basically we talked about this, the old gods and the new gods. I have treated Bitcoin as a commodity. That. We've talked about Ethereum as more of a longer term.
Totally, it's a protocol.
Infrastructure play, for lack of a better term.
Completely.
And Bitcoin as a commodity play. So Bitcoin has rolled, no question higher. And it was a beautiful technical setup, not once, but twice, because it formed a wedge recently. Mm-hmm. What doesn't sit necessarily so well in my tummy is, adding so much of it to the balance sheet, right? So even MSTR, which a client recommended strongly and has just doubled and doubled and doubled again, and probably doubled again. And yet those are unsecured loans that they're getting to buy another 600 million worth of Bitcoin for the balance sheet today.
Bonds, the bond issuance this morning.
Exactly. So it's insecure. The nature of that feverish pitch, they can get it. So it's free money.
I think Bitcoin itself, if you step back, like a lot of and I'm pretty busy. I got a lot of different stuff going on all the time. So I'm not going to sit here and tell you I'm the expert of everything. I know the stuff that I'm working on, and I, kind of read up on stuff that I'm not necessarily working on. I don't have a position in Bitcoin right now. I've traded Bitcoin back and forth, last couple of years. So it's always been a trade to me, because it's hard to kind of wrap my head around the dynamics of holding it and, the storage and so forth. And I actually even passed about talking about it one time, because I just don't know enough about the storage. My thought about it is, lately I've really felt like it was the narrative running on Bitcoin in the last 2-3 months reminds me a lot of the narrative in 2010, 2009, 2010, 2011 gold, which is the dollar is going to go to zero. This is protecting your purchasing power. It's a leveling up of the playing field. I mean, we're all hearing the same thing. It just, that's not like, that reminds me of a speculative type of
it's 5. I'm telling you,
it's like clockwork, right?
It is like clockwork. 5 o'clock, she's like, feed me. Oh my goodness.
Yeah, so like that Bitcoin has been getting a lot of that kind of conversation, and then it's attracted a lot of the me against them dollar purchasing power, especially in the free to trade echo chamber apps, like we've talked about extensively. Robinhood has Robinhood Crypto, and you can buy just a fraction of it. Gemini, you name it. So like the crypto is something I think is definitely going to continue to be sorted through, in the long term, I don't think it's necessarily good or bad or anything like it. It's just like gold, it's just like anything else. But like at this point in time, it's being very much bid in a kind of a narrative environment that I'm not necessarily sure has a lot of footing, right? Other than kind of continue to buy the buy. And there's like, you know, the whole stock to flow model, that it's a finite supply. You know, there's all kinds of different stuff out there about it as it relates to like real valuation. But when you look at kind of how and when that, I got to see the tether thing shake the tree,
Okay.
and the ruling on
I'm
that.
yeah,
Like
and
I
I'm
really
definitely
got to
not
see that.
I'm definitely not up to speed on Tether at all, and I just consider myself, you know, a solid generalist, not a specialist, but I am definitely
What we have looked into Tether, and the reason why is because when we started seeing the kind of the aggregation is related to Musk relating to his tweets,
yes.
MicroStrategy related to that. MicroStrategy is actually directly correlated with your analog of 1999. He is exactly doing the same thing he did in 1999. You can go look at his price chart as it relates to 1999, the one she showed, and where it's sitting right now today, and the same price action. There's actually a list of players that are in the same thing, same set of players that have been tracking since back then to now. So like there's a lot of stuff in there that to me we got to shake the tree. And it's just like, you know, this, you know, the gold thing had a lot of conversations, gold manipulation, you know, people have been, you know, going back and forth on that for a long time too. And that started right back then. So I think that my Bitcoin conversation is, I think right now it's directly correlated to liquidity, directly correlated to Tesla, directly correlated to Cathie Wood, and directly correlated to the way that they're coming out and creating a kind of machine to propagate the purchasing of that. And you have to go back to that incentive alignment. Once this passes, once March passes, once we see what the Southern District of New York Attorney General does, once you see, you know, what happens with the Tesla warrants and the calls, then you have a better perspective of the long-term kind of perspective of Bitcoin. And that's being completely transparent to you guys about answering that question. I don't think there's anything, you know, inherently wrong about having a digital asset that's transferable, transmutable, and that having that kind of protocol. I just don't, you know, people talking about it replacing the dollar, that's not really sensible, because the dollar is the way everything is monetized around the plumbing, right? You got to think about the SWIFT system.
By the way, do you see SWIFT has struck a deal with a JV in China, so they're now going to allow digital currency in the yuan, and this is easy to get. It's like Hotel California, right? You can check it in, but can you leave?
Yeah, 100%. I saw the same thing, but like the SWIFT system, so like everyone kind of understand what I'm explaining is like, if I want to send money somewhere, right, and I'm going to probably all of the existing infrastructure that works today with banks and everything else, like a regional bank, you know, community bank, you know, XYZ. They're set up in that SWIFT system. They're not set up in a Bitcoin system. Let's say that Bitcoin was, you know, garnered to replace it, right? And there actually has to be infrastructure and so forth, things, training, et cetera, to replace that. That's not just going to happen, right? It's literally not going to happen. It's like the dollar not being utilized. It's not like you're going to wake up one night and not have the dollar utilized anymore either, because it's not practical or sensible.
Talk about Bitcoin as it relates to dollar, because it's still priced in dollars. So let's talk about real quick a little bit on the dollar yuan USD CNH. Looks to me, finally, I've been waiting for this to put in a bottom, if you will, for several months now, and it looks like it is just ready to turn. So
yeah, you've been talking about that for a little bit.
So now it's one of those things where it's set up, and now it has to confirm, it has to basically then turn and confirm. So it's starting to turn, which would be higher dollar. My stock bond volatility ratio is about to tag, and when it does, it typically has a very big move. That's something I'm timing in the next, week or two. It doesn't mean that it's going to be a February, March 35% risk off type of thing, but it could be. So I have to see it tag and then confirm. That's just how I work. But we're getting into an area where totally separate from what you're seeing in market structure, and the legs of the table just keep getting taken out one by one by one. And now the bond, route, which could be very indicative of too much liquidity in the system and they have to raise some rates, right? This overnight, the discount rate, if you will. Fed's not going to raise rates. We don't think. It's Fed funds are 5%, projection, but they could, approach it a different way. So we'll have to see, but it seems like the bond market is immediately responding to that. And then you add on top of that the oil spike that we had, uranium spike, palladium, platinum, copper, it goes on and on. Commodities across the board are lumber. Oh my gosh, it's pressing $1,000. This is scary expensive for home builders. At what point will tech start to soften? Apple, by the way, looks like a fabulous short. The only short I have recommended to clients last week. It's like, so far, it's just, it's got like another $10 to go. It'll be perfect. But the point is, there is not a lot still in the equities market that looks shortable, other than, a few select plays. Bonds are definitely looking dangerous. That's a concern. Volatility, it might need some more time. We've got, expiration tomorrow for VIX, and then February expiration. I'm curious if there's going to be some selling in the ARK fund of Tesla, just because she made that comment before he announced they bought Bitcoin into their on their balance sheet. So, and Tesla right now makes the market. It used to be Apple.
Yeah, I mean, we're kind of at we're I think summating my thoughts is just the table, right? You've got a bunch of different stakeholders at that table now, and then you have and it's a circular table, and there's a lot of people offsetting each other at that table. So there's going to be some binary impacts to this. And what are those, right? And we've pulled forward years and years of price, right? And I would say, like, when you look at like good companies, and I said this the other night, it's like when you look at good companies that are going, up to 300% in 12 months, stuff like that, that have had a decent trajectory for years. Is that price? And Jared touched on this on Thursday last week when he was talking about a decade of declining returns, right, or mediocre returns. Something's got to catch up. And to like take a step back from that table, that's what I would say. It's like, price has been pulled forward, and value has not really changed, and things have changed dramatically in the entire environment. And now you could see a period, like, once this kind of trigger, once there is some realization that the interest rate situation is going to modify itself, or be modified because it has to be because of these unintended consequences, then you begin to look at the prices of all these things, and there could be, completely bifurcating for a substantive period of time. I think we're approaching that pretty quickly here into the after this expiration Friday, into the March expiration, and the one after that. This 8-week window is pretty interesting, with a lot of different things going on. And as always, the market can go wherever it wants to go based on the participants, but that table's getting really uncomfortable. And it's like, what do they call it? Like, we're going to break a stick and throw it on the table and see who survives. Like, with people, like, I think the stakeholders at that table are not all on the same page and can't be all fed right anymore. So something's going to give.
Well, right now the market's a little confused. While it rallies on higher yields, inflation expectations, perceived bond to stock rotation, as bonds obviously fall. But in fact, I think the higher yields are going to force the Fed to raise the discount rate, or something that is not right now clear or priced in. Volatility for me is just going to be a recurring theme. We're going to talk about that. I've given the warning because obviously this week I wasn't expecting it actually until after the February options expiration. But now I'm saying, with this,
it could be any time now. Yeah, table's real tight.
With bonds and gold, by the way, looks like it's going to crash lower. It really is
vomit. Looks like
not
vomit.
a safe place right now. So gold is not going to serve as a risk off. I think it's going to be dollars. And right now, they're definitely unwinding a little bit of some big tech. We'll see earnings as a broad base.
Speaking of the dollar, like the trend structure, market structure on the dollar looks to be creating some sort of like kind of what is called a market maker buy setup, like where you can get like where it's going to come maybe retest the low from a little bit ago, and if it doesn't make a low there and it holds that and goes right, so kind of comes down, holds it, goes, then that was the best spot to get in because you just set a stop at the previous low.
Yeah, I think it's done
I think that
down.
could definitely happen. Yeah, definitely happen.
It saved itself, and I think it's done going down right now. But this chart I'm bringing up because this was Chris Cole, and it was printed a little while ago. But basically, I guess this is I'm inferring here that GameStop and VIX index, there's a lot of parallels. And in the same way that maybe not retail can inflict pain on hedge funds with a short squeeze, but definitely there's something in this structure that does look foreboding. So I'm definitely looking at the bond route and now the volatility potential after this week as picking up. And I also can't help but wonder what the heck is going to happen with this particular chart that just caught my attention today, because never has TLT been down on the floor like this. So this, to me, if nothing else, can trigger a sharp rebound. And on a monthly, it looks very different. It still looks like a short, but at least on the short term, it'll be curious to see what happens. We should probably end, and just want to remind folks that I'm doing the Women in Trading and Finance webinar on Thursday, and then next Tuesday, Jonathan and I will hang out together and see what's happened after VIX expiration and monthly. I am very much looking forward to getting feedback on the indicators that we have launched on your platform. Couldn't be happier about that whole move. Excited. We're in beta testing right now, and then a little, hopefully in 2 weeks, once we get all the ETFs rolled out, we can do another kind of onboarding and let people have free access for 2 weeks before they get rolled out in the Apple Store.
Totally.
Did we answer all the questions? Okay, good. I hope so anyway. Buffett just exited gold. Thank you, Lloyd. No kidding.
That's about right. Yeah.
Okay. Is it not holding as a store of inflation hedge, or anyway. I'm curious.
What I would say, the last thing I'll say, then I'll jump off, is that the market structure is so violent here because of the options, that any of these triggers at the table could ignite that setup where it will then torch itself. And I think it's the entire market structure, the entire infrastructure, the fact that you've got so many more options being traded than the underlying securities, and such a massive interest in options at the moment that will be there after all this, but maybe in a little bit different way. This market structure is highly dangerous. So whether it's a week, 2 weeks, 2 months, if one of these things triggers, you're not going to have a lot of time. That's what I'll tell you. It's going to shift on you pretty quickly.
And the tough part is when it starts, it's probably going to be a lot. I'm not saying that this is it. I still think we can go higher in the S&P.
Totally agree. Totally agree.
The process for the volatility regime is about to start. And when my ratio triggers, it goes for months. It's not something that just is one and done. That was a technical setup back on the 20th.
Which is the shape that it's setting up now with the dollar, which is the shape it's setting. These are longer term setups that are starting to form. They're not triggered totally, but they're forming.
Got it. All right. Darren's also saying he reduced Apple. Yeah, well, they're taking some things off the table. It's prudent. And I mean, they've had some great wins, but I think that also shows the regime change. I'm curious if he bought Bitcoin. I'm kidding. All right, I'm going to wish you all a great evening. I clearly have to go feed my cat.
It's great. Hey, great stuff on the bond stuff. That's excellent. Excellent work. Thanks for sharing that.
Let's watch silver, because I'm fascinated by this whole, reserve currency, hoarding silver as absolutely a tell.
$16 SLV, 15, $16 I've been eyeing for a while. That's just sheer market structure level. You can see it very easily.
That would be it, huh? It'd probably be a deal at that level.
Yeah, I think 14 would be like, back the truck up. Yeah, you guys think I'm crazy. It might happen.
Yes, but in the meantime, silver futures, they are shorting that puppy. That's how
that's how they roll.
That's how they roll. So careful. It's tough to be long if that's what they're doing.
Yeah, 100%.
All right. Greetings and thank you so much. Have a good night. Bye.
Thanks, everybody. Thanks, Samantha. Bye.